Bringing Bill Baruch. He's joining us to break this number down. He's the president of Blueline Futures. Bill, good to have you back. Jobless claims. What's this number telling you? It continues to improve. We're talking, well, better than the expected 215,000. We got 184. Now, I'm looking at last week's, a slight revision, it looks like, to 227. So a little bit higher from last prior 222 initially. But, I mean, this is a strong number across the board.
Yeah, thanks for having me on again. And you're right; it's a strong number. Yeah, I guess it's digested with a grain of salt into tomorrow's CPI, because that's really what's going to matter. You noted the tick up from last week's read for the week of Thanksgiving, but overall this has been trending lower, and we know jobs have been trending lower, but I mean the jobless claims have been trending lower, but I mean non-farm payroll isn't quite there. I know a lot of people looking back at last week's number talked about seasonality and it not being as bad as the headlines. Listen, I'm taking it for what it's worth of what we had last Friday. It was not a good number. So I think jobs are mixed. There's a lot of question marks there, but it's really about the inflation.
You know, I want to just take a quick look at the charts here. There's the number. Let's look at market reaction too. And I agree with you. And we were just talking about that. The focus is inflation. Certainly, I don't think this is a major market mover here. It's better than expected. That's encouraging and in line with the trend we've been seeing. Speaking of the trend we've been seeing, here's the move up off the lows that we saw again last week, around, well, just below 4,500. We're back up above 4,700, and here's the dollar. It's kind of just holding this 96 level. I wanted to get into the dollar, and do you think that this number tomorrow, CPI, I mean, the Fed's been pretty clear on where they stand. I guess maybe would raise some concerns or some expectations that this could speed things up if it came in a little bit higher than expected? Or are we just at the point where we've accepted that the taper's either going to speed up or, again, the Fed's going to have to just continue to admit defeat in many ways? I mean, inflation seems to have gotten the best of the situation here.
Looking back to last week, Fed Chair Powell, everybody knows he turned more hawkish. He really surprised markets. Yeah. And what he's, with that now layered in with the Omicron uncertainty, he's going to have a needle to thread next week. And it's those uncertainties are still there. Look what's going on in the UK right now. And they're pulling back, or reinstating some measures, which potentially will be pulling back some policy tightening expectations. You look back at, you look forward to next week. If inflation is there, they're looking for, I think, a 0.5 increase, and that comes on a month over month, comes on the heels of a 0.6 increase for October. It's a pretty steady increase, but at the same time, I don't think it gives the Fed a real solid reason to speed up the taper if these virus uncertainties persist. There's no reason for them to hold a very slow line, say they want to be behind the curve all year long, and then now that the virus sort of gives a new layer of uncertainty, that they change their path. That would be that would bring a lot of confusion. I think that would make really bring risk assets in, and I don't think the Fed wants to do that either. But what we could see from last week's hawkish stance, coupled with an inflation number that's in line to potentially hot, we could see peak hawkishness from that, and then the Fed come in less hawkish, and the markets like it.
I just want to pull up the dollar index on the 90-day. This is an hourly chart here. We're looking at about 90 days worth of data, and you can see the nice run up 91.80 and how it's just kind of gone a bit sideways since. Now, in terms of central bank activity next week, a good breakdown in terms of what to look for as far as the Fed. Here, you mentioned the British pound. I just wanted to point out, since the beginning of November, it's been weakening, supportive of the U.S. dollar to the upside. You've also got the 6E. This is the euro currency bill. We've got the ECB next week as well, in addition to the Bank of Japan. I mean, here you can see where the yen is. It got that lift. I think this was that flight to quality safe haven type tendency, which, well, we can see really is yet to come out of the market, even though we continue to hold near those all-time highs, 3 days to the upside in the ES. Other than the FOMC next week, what should we be looking for from some of the other central bank activity that's expected?
I think there's going to be a lot of wait and see. And if the Fed is more hawkish, that's going to get the dollar going. And that's what I think, that we're at this time right now, that if everybody else is peeling back their hawkishness, we could see peak hawkishness from Fed Chair Powell, with a number tomorrow that, like I said, could be in line or hot. And overall, it sets a bar. And markets like that. You know, if we put the peak hawkishness, at least for now, in the rear view mirror, we'll get some volatility for sure coming out of it. But holding a good technical landscape in the stock market, I think that sets the path for new record highs into the year end, because they're going to pull back from what the bar that was set. That's how I'm looking at it.
Seems like the Fed at this point, well, as long as they remain transparent, the market has shrugged off a lot of the concerns tied to the taper, the inflationary concerns, even that shift from the transitory to a much more hawkish tone, as you mentioned. The euro, it seemed like a vote of confidence in the new chancellor yesterday, and Angela Merkel leaving after, I think it was 4 terms, 16 years. I mean, does this bring about any concerns or any chances that we could see some movement there? We just pointed out again that some of the weakness we've been seeing, again, which has been supportive of the U.S. dollar.
Yeah, I mean, I think we're just going to see continuation of the trend, and right now the ECB, there's a lot of influence from all regions there right now, and I mean, I think the euro is trending lower for that reason. I don't see that trend to change necessarily, but what will change it is the dollar, the impact of what the dollar is doing. And that's really why I'm focused on the Fed next week. I think it's going to be more of an impact on that. I do expect the dollar to weaken, and I think, as we even saw the type of strength that came out of the dollar following Fed Chair Powell last week, it quickly dissipated, and I think that really set a tone in my mind. We've had this dollar rally. It stuck its neck up here to new highs in the year. It went back and sort of erased that fallout from Q4 of last year. And I think that's the important thing. I mean, we've back tested now, and I think that even if the Fed starts to become and feel more hawkish, they're not going to be able to maintain that. We're seeing 2 to 3 rate hikes being priced in next year. I just don't see that happening. I mean, unless inflation just really takes off. And I do expect inflation to be steadfast, but I don't think the Fed is going to be able to move to at the rate that's being already priced in. So that makes me bullish on the 30-year bond at potential at decent levels, not necessarily just staying long with it, but I think there's a great way to trade and buy dips within the 30-year bond at times. I think that, I mean, I wouldn't be surprised to see continued volatility in the 10-year yields. I mean, just kind of chop around. But and even if the Fed is a bit more hawkish and some of that inflation shows up, we do see 1.7 and 1.75. But I really think that's going to be a ceiling for things and from a yield standpoint. So those are I think we're just at a really sort of a pinnacle of time here over the next 30 to 60 days, and we'll get a lot of answers. And if you're looking for moves in the market, I mean, look what happened in the equity market last week. We rebounded so nice and so quickly, but I don't think these are levels to be pressing it over the next couple of days. And I think a lot of people have that standpoint. The market's really just digesting these gains right now, and we're waiting for more news from the Fed. So if the Fed kind of lays that hawkish bar out, and then they're less hawkish, we could see again, it's a little bit of volatility over an hour or two, but I think the market resolves higher from that as it coming out of digesting these gains right now. So again, it's a really interesting next few days, and we'll have a lot of answers over the next week.
Also, the COVID variant, again, the new variant playing into this, and we were just looking at the 30-year futures, the ZB contract, as you spoke to the opportunity there. And here you can see the yields, the TY axis, the 30-year yields. You mentioned the curve. Let's talk a little bit about, because we've seen here a range in the 10-year range, but the 5-year I noticed on the move, the 2-year on the move. Again, yesterday, futures to the downside, rates on the short end to the upside continues.
Yeah, looking back at the breakdown in the 30-year spread, or I'm looking at it from the the 35 spread.
Okay.
It's as a breakdown. There's a trend line support. So I'm looking at that spread, and last week it broke through it. We've seen the spread between the 5 and the 30-year at levels last seen of the first week of March of 2020, when Saudi Arabia and Russia had their split, and OPEC was saying they're going to produce into the face of COVID. So you're talking about a disastrous situation. I remember, I'm sure you remember that Sunday night open, that Monday volatility. You're talking about an absolute disastrous situation. The world was falling apart. The 5 and 30-year spread was at that level. That is where we basically are right now. That says a lot. I mean, that says what the bond market really thinks of the direction of not only the U.S. economy, but the global economy and the uncertainties that still lie ahead.
All right, I'd agree. And we're looking at it here right now, 5 versus the 30. In this case, we've got the 5, the FVX, it's the candles. The 30 is this purple line. Bill, appreciate you giving us part of your Thursday morning and helping us take a look at the number. Bill Baruch, Blueline Futures.